All right, welcome to the Explainer. Let's just jump right into this because right now, the entire financial world is absolutely mesmerized by the SpaceX IPO. And I get it. We're talking about a record-shattering $1.77 trillion valuation. It's huge. But here's the thing. While everyone is staring up at the rockets, almost nobody is paying attention to a quiet, massive rewiring happening right under our noses. That's the real story today. The spectacle of the most hyped public offering in history is essentially acting as a giant distraction while a trapdoor is being installed directly into your 401k.
So you gotta ask yourself, does the biggest IPO in history actually matter to your 401k? I mean, it feels like it should, right? But honestly, the SpaceX IPO is basically a magic trick. And you know the rule with magic tricks? When the illusionist waves his right hand to create a huge spectacle, you should immediately be watching what his left hand is doing. While retail investors are climbing over each other for a tiny piece of the rocket, the actual target of this whole systemic shift is the $12 trillion sitting quietly in American retirement accounts.
To see how this plays out, let's look at our two avatars for today, Logan and Dana. On the day of the IPO, Logan opens his brokerage app, deliberately buys shares at $135, and proudly goes to sleep after a sweet 19% first-day pop. Good for Logan. Then you've got Dana. Dana hasn't looked at her 401k in, years? She's parked in a totally boring autopilot Target 2055 index fund. She does absolutely nothing. But as we get into this, you're going to see exactly why Dana's lazy, accidental strategy is actually positioned to look infinitely smarter than Logan's active one. Well, unless these new rules completely change Dana's default fund without her even realizing it. Let's start with the sheer absurd scale of what Logan actually bought into. $1.77 trillion. With a T. That's the valuation SpaceX commanded when they basically handed the market a single price of $135 a share and said, take it or leave it. And demand was absolutely staggering, reported at around $250 billion. But what made this truly unique wasn't just the size of the number, it was the access. Normally, retail investors just get the crumbs after the big Wall Street institutions eat. But here, an incredible 30% of the available shares were allocated directly to regular retail investors on standard trading apps. It felt like a total gift. But hold that thought for a second. Because while Logan is busy celebrating his day one gains, Dana's 401k is hitting a massive roadblock. See, to get into the standard index funds where most everyday retirement money actually lives, a company needs to enter the S&P 500. And the S&P 500 just slammed the door right in SpaceX's face. Why? Primarily because of this number right here. A staggering $4.9 billion net loss reported in 2025. It totally shatters the illusion that a giant, flashy IPO means immediate inclusion in your retirement portfolio.
What's really interesting here is understanding why that loss matters so much. You see, the S&P 500 isn't just a list of the 500 biggest companies. It's a highly exclusive VIP club, and it has a very strict bouncer. To get in, you need a market cap above $22.7 billion, which obviously SpaceX clears effortlessly. You also need to be publicly traded for 12 months. They call that seasoning. And crucially, you need 4 consecutive quarters of positive earnings. Real, bottom-line profit. Now, earlier this year, Wall Street literally begged the index committee to bend these rules for mega-cap tech and AI companies. And the committee, they flat out said no. They essentially ruled that just being enormous is not a substitute for actually being profitable.
Now, to be perfectly fair to SpaceX, that massive net loss is highly nuanced. If you look under the hood, their satellite internet business, Starlink, is an absolute cash machine. It's generating over $4 billion in operating profit. If Starlink were a standalone company, it would sail right past the S&P bouncer. But SpaceX took all that profit, plus billions more, and shoved it into a staggering $20 billion capital expenditure for AI infrastructure and the XAI merger. It's a highly visionary choice to build the future, no doubt. The problem is, the S&P 500's strict, mechanical rules cannot tell the difference between visionary spending and a broken business model. They literally just see a negative number on a spreadsheet.
So, let's map out the timeline and see how this builds into this sort of slow-motion event. Because of that profitability rule and the 12-month seasoning period, Dana's standard S&P 500 index fund won't even touch SpaceX until late 2027 at the absolute earliest. And before it gets anywhere near her 401k, the stock has to survive some incredibly dangerous, volatile lockup expirations. In late 2026 and mid-2027, the floodgates open. That's when early investors and insiders, including Elon Musk himself, are finally allowed to sell their private shares. And historically speaking, massive supply flooding the market causes wild, unpredictable price swings.
Here is where it gets truly wild. If SpaceX survives those volatile swings and finally clears the S&P profitability hurdles,
A mechanical, forced buying machine kicks in. Every S&P 500 index fund on the planet will be contractually obligated to buy SpaceX stock to match the index. We're talking an estimated $100 billion of blind forced buying. We saw this exact same thing with Tesla back in 2020. Traders aggressively front-ran the index funds, driving the price up 40% before inclusion even happened. Your retirement fund doesn't care. It will just blindly buy at whatever inflated price the market dictates on inclusion day.
So historically, all of these S&P rules, the profitability screens, the seasoning periods, they've acted as vital guardrails protecting your retirement savings from speculative, unproven assets. But while everyone is out back watching the rocket launch, Washington is quietly dismantling those exact guardrails. Take a look at this executive order. It sounds incredibly friendly, right? Democratizing access to alternative assets for 401k investors? Wow, democratizing. But what it actually does is direct regulators to lower the strict fiduciary standards of a law called ERISA. It's opening the door to let expensive private equity, real estate, and risky pre-IPO stakes flood into the $12 trillion pool of everyday workers' savings.
Let's cleanly contrast exactly what they are trying to replace here. Let's put them side by side. Dana's current, totally boring S&P 500 fund charges practically nothing in fees, around 0.03%. You can sell it instantly any day the market is open, and you enter at the public market price. Simple. In stark contrast, consider the private equity vehicle they want to bake into your default choices. It comes with massive fees, often the infamous 2-in-20 structure. Your money is locked up and restricted. And your entry point? Yeah, you're getting in right after all the easy explosive money has already been made by the insiders.
Now, to be totally fair, let's look at the steel-manned bull case from the asset managers pushing this. Giants like BlackRock and Apollo argue, and they have a point, that regular people have been unfairly locked out of the fastest-growing companies while they're private. BlackRock research suggests that adding private assets could add about 0.5% of return per year, which, okay, doesn't sound like much, but compounded over a 40-year career, that equals roughly 15% more money at retirement. That is a genuinely life-changing number. You can completely see why the allure of capturing early-stage growth is incredibly powerful for people.
All right, Section 3, the 3 hidden risks of the democratization pitch. Whenever a massive systemic change is marketed to you with a friendly word like democratization, you really need to look closely at what is actually happening behind the label. The first huge risk is the brutal, quiet math of fee drag. Look at this. If you invest $100,000 at a 7% growth return for 30 years in a near-zero fee index fund, you end up with about $750,000. But if you put that exact same money into a fund with a 2% annual fee, even if the gross performance is absolutely identical, you end up with just $430,000. That seemingly tiny 2% fee just vaporized over $320,000. Poof, gone. That is more than 40% of your final retirement balance quietly transferred from your pocket to someone's bonus year after year.
Risk number 2 is illiquidity. With a standard index fund, if you have a financial emergency, you click a button and boom, you have cash. Private assets do not have a daily sell button. Imagine we're in a market crash, you might lose your job, you desperately need cash, and you try to pull money from your own retirement account, only to find a chunk of it is stuck in a private fund that basically says, yeah, sorry, the redemption window is closed. Your own money is legally trapped right when you need it the absolute most.
The third, and honestly, perhaps the sneakiest risk, is the valuation you're actually paying. When SpaceX IPO'd at $135 a share, it valued the company at an extreme 94 times its annual revenue. 94x. Early venture capital insiders, like Founders Fund, invested when the company was near bankruptcy and saw a 2,500 times return. By the time a company is actually large enough to be dropped into millions of everyday retirement accounts, the explosive growth phase is over. Retail investors aren't getting in early, they are paying peak prices, effectively serving as the exit liquidity for the early insiders to cash out.
If you want a literal preview of what happens when desperate retail demand meets restricted supply in these alternative vehicles, just look at the side doors that are already built. Take the Destiny Tech 100 fund, ticker DXYZ, which holds private shares of SpaceX. At one point, retail investors pushed this fund to trade at a massive 2,000% premium above the actual value of its assets. People were literally paying $3 for $1 of value. As Morningstar bluntly warned, this setup lets investors enrich others at the expense of themselves. It is a glaring, flashing warning label for this entire democratization pitch. And we have to remember, this is all happening against the backdrop of a massive macro trend, the shrinking of the public market itself. Back in the 1990s, there were about 8,000 publicly traded companies. Today, there are only about 4,000. Companies are staying private much, much longer and capturing all their explosive growth behind closed doors. Even Wall Street titans like Jamie Dimon are uneasy about this.
The systemic shift means that the public markets, where regular people are legally allowed to invest, are increasingly just getting the mature, expensive leftovers. And frankly, this is a bipartisan concern shared by politicians on both ends of the spectrum who are getting really nervous about the implications.
So what's the playbook here? How do you take back control? Step 1, log into your 401k today and literally just check your expense ratios. Protect your low-cost funds. Step 2, translate the marketing speak. When you see buzzwords like democratized access, recognize it often just means high fees and locked money. Step 3, always separate a phenomenal company from a phenomenal price. Look, SpaceX is an incredible company, but 94 times revenue might make it a terrible investment right now. And finally, respect the boring index fund. Boring is the cheat code for wealth building. Do not let anyone shame you out of it.
We've covered a lot of ground in this explainer, peeling back the layers of the biggest IPO in history to reveal the hidden machinery working behind the scenes. So I'm going to leave you with this final vital question to ask yourself as you review your portfolio tonight. Is your retirement account quietly working to build your wealth, or is it being subtly rewired to fund the exit for the insiders? Paying attention when everyone else is distracted is the only real edge you have. Check your 401k today, read the fine print, and make your money count. Stay sharp out there.